Good evening, my name is Michael Pappas. This is Joseph Drabala and Tyler Preborg. We're here today from the University of Florida to pitch to you our buy recommendation for Bloomin' Brands. So Bloomin' Brands is a restaurant holding company that originally IPO'd in 1991, then consisting of just 49 Outback Steakhouse restaurants. The company was bought out in 2006 in a transaction led by Bain Capital. Bain then took the company public again in 2012. Today, Bloomin' Brands consists of 4 key concepts: Bonefish, Fleming's, Carrabba's, and the original concept, Outback, which today still makes up a majority of the company's revenue. As of Friday, shares were trading at $23.61, representing a market cap just under $3 billion. We're very excited about the opportunity at Bloomin' Brands. We see a very attractive risk-return profile. Now, we see growth that's going to far outpace their peer group as the company capitalizes on significant emerging markets opportunities. Also, cost and productivity initiatives are going to raise margins to at least peer levels, a goal that management has set for itself. Also, we've identified a near-term catalyst in the form of more debt payment than is currently anticipated by the sell-side investors, which we think will lead to a material beat to earnings per share estimates as soon as next quarter. Also, management has recently shown us that they're ready and willing to return cash to shareholders, a trend that we see not only continuing but increasing in the following months. So with that said, we issue a buy recommendation and a $30 price target.
All right, so now we're going to go through the industry overview and the competitive analysis of that industry. The restaurant market industry is broken up into 4 subcategories. Those include fast food, fast casual, casual dining, and formal dining. Casual dining accounts for 1/3 of the entire market, and in Q3 2014 realized a modest same-store sales growth of 1.9%. Bloomin' Brands is encompassed within the casual dining sector and owns 4.5% of that U.S. market share. They're outpacing peers with doubling same-store sales growth in Q3 of 2014. Now we're going to transition into the competitive trends that need to be addressed by the players in this market. The first being a saturated U.S. CDR market, the second being a lack of prime real estate in the U.S., and third being a change in preferences for a faster dining experience. Bloomin's addressing the saturated U.S. market by leveraging their local and experienced management team in Brazil and other emerging markets where they currently are, where middle-class growth is continuing. Secondly, they're addressing a problem of a lack of prime real estate in the U.S. by remodeling instead of buying new sites when available. And again, they are targeting more expensive sites in their emerging markets, primarily Brazil. Lastly, they're targeting changing preferences by offering online ordering and a consumer roadmap, which is going to increase restaurant efficiency. They plan to save $50 million a year from 2015 to 2017 with these tech investments. So these solutions have paid off for Bloomin' to these trend problems, and currently they own a top 5 market position within each of their portfolio concepts' respective subcategories.
Okay, now to get a little bit into the investment opportunity. Our buy recommendation is largely driven by what we see as increasing earnings and profitability over the next 5 to 6 years. This is driven in part by decreasing growth in the United States and much higher, more rapid growth abroad where we see higher margin stores. Additionally, as mentioned before, the productivity initiatives will add $50 million of annual savings, which will help boost the margins. Additionally, the relocation and renovation of units within the United States from B-grade real estate locations to A sites. Along with that, we typically see a 20 to 40% boost immediately to sales with corresponding margin increases. And finally, Brazil, which I'll touch on now. Brazilian stores, which is all Outback right now, currently have an operating margin of about 10% versus 5% for domestic stores. And the Brazilian opportunity is largely driven by the growing middle class in the country, less competition. It's a very fragmented market. Bloomin' is actually the largest chain in the country. Outback's market share is twice its nearest competitors. And they have a very strong brand, which has been in the country since the early 90s. The higher margins are largely driven by a lower cost of goods sold and lower cost of labor, along with higher unit sales, as you can see in this chart here. Additionally, we see a near-term debt catalyst to the stock, which will be accretive to earnings per share. They refinanced their term loans in 2014, which along with that came some new covenants, including the fact that they have to prepay 50% of their excess cash flow to pay down debt until they reach a debt to EBITDA of 2.5 times. We see their significant excess cash flow over the next 1 to 2 years, helping them do this a lot faster than everyone else expects. And we actually believe the debt to EBITDA will get below 3 times by year-end 2015. Sell-side models and estimates do not incorporate this accelerated debt prepayment and only account for minimal amortization. We believe they over-account for interest expense, and taking out this interest expense after the paydown will lead to a 7% and 30% earnings per share beat in 2015 and 2016. Additionally, management has shown that they're ready to return cash to shareholders now that they're generating excess cash flows. In December, they initiated their first annual dividend of 24 cents per share and authorized a $100 million share buyback over 2015 and 2016. They've actually already purchased $70 million worth of share within just the first few months of the buyback, which we think shows they believe the stock is undervalued and possibly will expand this buyback program. We conducted an analysis of Bloomin's peer companies after their first initiation of a buyback. As you can see here, they have pretty significant outperformance versus their peers over a 2-year period. Their use of cash first goes to fund CapEx, then for debt reduction, and finally to pay back shareholders in the form of dividends and buybacks. We believe this will act as a near-term or medium-term catalyst to the stock as they continue to generate excess cash flows and pay these towards shareholders.
Next, I'll be discussing our financial analysis and valuation. For starters, to project revenue, we use a bottoms-up approach based largely on management's guidance as well as historical assumptions for revenue on a per-unit basis, so by concept type abroad. From there, we were able to come up with the following projections. I'd like to note that even under our most optimistic of assumptions, we assume that management adds new restaurants at the low end of their guidance. Typically, they've been at the higher end, at least since the IPO, with our base case being a haircut even below guidance moving forward, so we consider our projections to be fairly conservative. So from there, we came up with the following projections. We are pretty confident that management can grow the top line between 7 and 9% per year for the next 5 years. This coupled with the growing margin will lead to significant EBITDA and free cash flow growth. So the main story here essentially is expanding operating margins coupled with decreasing leverage, we think will lead to significant earnings per share growth, far outpacing the peer group, and currently what is being estimated by investors, and eventually leading to significant share price appreciation. We also compared the company to their 6 closest peers, found that they're currently trading at a moderate discount. Now, we attribute this mainly to investors' misinterpretation of the emerging markets opportunity, as well as to higher than normal leverage. However, as the company repays its leverage, as Joe recently talked about, and as investors gain confidence in management's ability to grow the company abroad, we see multiples expanding to at least peer levels, which could give us another potentially 30 to 40% upside as the share price rises from $23 to somewhere around 31 to 34. As far as intrinsic value is concerned, we mentioned before that we see significant free cash flow growth. In order to account for some of that excess risk abroad in the emerging markets, we utilize the Goldman Sachs model for cost of equity in emerging markets, which helped us arrive to a weighted average cost of capital just under 9%. So after sensitizing this with some of our other assumptions, we arrived at the following valuations. And even our very conservative base case, we see that the company is currently trading at around a 6 to 19% discount to its intrinsic value. We employed a REIT valuation just to see what some of the restaurants' properties would be worth if spun off into a REIT, as well as adjusted present value analysis just to consider the changing capital structure. However, we ended up leaning mainly between our discounted cash flow and comparable companies analysis to arrive at our $30 price target, which represents a 27% premium to Friday's close price.
Now to touch on a couple of the risks. Our buy recommendation is largely driven by the emerging markets growth opportunities, specifically in Brazil. The strong dollar obviously has been a concern of investors in terms of the earnings for companies that have a lot of earnings abroad. And we believe this is largely overblown due to the fact that they're not actually repatriating their cash, they're investing it there. So over time, we expect the currency to revert back to the mean by the time they do actually repatriate that cash. Additionally, cost of labor is about 30% of their cost of goods sold. And minimum wage is kind of a hot topic in the United States right now. They have seen in 5 out of their 10 largest states minimum wage increases over the past year. However, they're typically able to pass these costs onto the consumer in the form of price increases. Additional risks could include food inflation, an oil price rebound, execution risk abroad, and leverage which is above peer levels. In our bear case scenario, we assume that only 60% of management's 5-year margin goal is hit, along with store openings 40% below the low end of management's guidance range, which we believe to be pretty conservative. This comes up with an intrinsic valuation of about $21 per share, which is about 10% downside to the recent close.
In summary, we're very excited about this Bloomin' opportunity. Like we mentioned before, we see significant, very attractive risk-reward profile as the company capitalizes on growth in the emerging markets, brings margins down. Our upcoming debt catalyst leads to a potential EPS beat, and as management continues to return cash to shareholders, we're very confident in our buy recommendation. We'd like to reiterate our $30 price target and open it up for questions. Thank you, guys.